to FX Talk, an Ebury podcast all about the foreign exchange market. My name is Matthew Ryan. I'm joined, as usual, by our chief economist, Enrique Diaz-Alvarez, and we're delighted to be joined by a very special guest this week, Ebury's Director of China Initiatives, Isabel Ye. Isabel joined us back in 2018, having previously worked for the likes of McKinsey, and more recently as Head of Market Risk at Santander, and she's very much our resident expert on all things China, and we'll be talking all about China, the tariffs, and more on the podcast a little bit later on. So thank you, Isabel, very much for joining us today.
Thank you, Matt and Enrique, for inviting me. It's a pleasure for me.
Problem. I wasn't aware until yesterday. You're a fellow CFA charter holder as well, is that right?
Yeah, that's right.
Fantastic. Well, belated congratulations. We know firsthand just how difficult those exams can be.
Yeah,
what have we got in store for today, though? Well, in this week's episode, we unpack what was another very underwhelming non-farm payrolls report, which has sent yield curves into a tailspin and made central bankers reach for the aspirin. This has essentially put pen to paper on a September rate cut from the Federal Reserve. But what can we expect from next week's FOMC meeting? We'll then take a deep dive into China, and Isabel will be giving us a rundown as to how the US tariffs are impacting Chinese exporters and what we can do to mitigate those risks. But first, let's start with the main news and developments that we've seen in markets in the last couple of weeks. Probably the main news story has been we've seen growing expectations in favour of Federal Reserve interest rate cuts. That follows some dismal data out of the US jobs market, including another weak payrolls report for August. We also had some brutal downward revisions to previous data. The Fed will be unveiling its September rate decision next week. That's on the 17th of September. And now not only is a cut fully priced in, but markets are eyeing cuts at each of the next three meetings in 2025. Markets are also growing increasingly fearful over Fed independence, particularly following Trump's attempted firing of Fed Governor Lisa Cook. These concerns have not only triggered a sell-off in long-dated bonds, but a continued depreciation in the dollar, which has fallen to its weakest level against the euro since July. Political woes have re-emerged in France. That follows Prime Minister Ebury losing his job following a confidence vote, possibly paving the way for fresh elections. Meanwhile, in the UK, the big story last week was this mass reshuffle that we saw in the Labour cabinet following the resignation of Deputy Prime Minister Angela Rayner. Importantly, however, Chancellor Reeves has remained in post, for now at least, with all eyes turning to the autumn budget, which is set to be unveiled on the 26th of November. But let's dive into what these headlines mean. We'll start, Enrique, with the state of the US jobs market, because last week's payrolls report was undeniably soft, only 22,000 net jobs added. Even more alarmingly, the BLS, I should say, annual revisions, which showed 911,000 less jobs than initially believed in the 12 months to March. To put that into a little bit of perspective, that's 76,000 less jobs per month. And in the last 6 months, the US economy has only added, on average, 64,000 net jobs. So some alarming downward revisions there. What do you make of the data overall, and does this sour your optimism towards the US economy?
I mean, what can you make of the data? Do we know that the revisions only covered the year through March, I believe? So, what are the 6 months since they're going to be revised away at this time next year? It's shocking the unreliability of probably the most critical data point in the world, which is the U.S. payroll report. It is probably with inflation, the two data points that drive Federal Reserve policy making, and it turns out that the picture they have painted over the year ended in March was significantly exaggerated. Like going from 150,000 jobs being created roughly a month to the reality, which was only 70,000, changes completely the picture, and it means that the Federal Reserve has been making decisions based on faulty data. It is extraordinary that the Bureau of Labor Statistics is unable to come up with reliable numbers. Let's not forget that the U.S. is probably the only major country or minor country that I know of where this number, it comes from a survey as opposed to from hard data from the tax authorities. So it's clearly the picture is a lot worse. With the original data that I and others were relying in, you had a picture of an economy that was at or near full employment, creating a steady though unspectacular amount of jobs every month. And in reality, what you had is a labor market that has been sputtering and that has been creating far fewer jobs that are needed to maintain full employment. So it is likely that the Federal Reserve probably should have been cutting for at least the last couple of meetings, and it didn't because it was relying on faulty data. So shocking, and that's bad news for what it says about the U.S. economy, and bad news for what it says about the state of the U.S. Ability to monitor economic data.
Yes, I mean, absolutely brutal, isn't it? It's quite amazing that we could have such data that's so significantly wrong.
And you know, the revisions have been huge and have been in the same direction. So that tells you that there's not just statistical noise. There's some real problem with the way the BLS raises its data, and it's been years, and they have done nothing.
It very much calls into question what faith the market should put in the data as well. I mean, as you said, the payrolls data every month is the single most important economic data released on the calendar. We usually see the most volatile moves in markets off the back of it. But if investors are not, they can't trust the data, then it really does call into question as to whether this should be the number one focus for markets. Aside from that, it also makes it very difficult, of course, for the Fed and the US government to make decisions, policy decisions on data that is clearly is very unreliable. But this wasn't the only data that we've seen in the last few weeks that is a surprise to the downside. Actually, if you look at recent labour market data out of the US, the more sort of tier 2 data, they've deteriorated as well. Jobless claims are up. Private sector employment, that's the ADP. Employment change number, that's averaging around about 50,000 a month in the last few months, which is well below recent averages. Job openings continue to drop, and actually the number of vacancies have dropped below the number of unemployed Americans for the first time since 2017. That's excluding the pandemic period. That's generally a sign of labour market slack and a possible harbinger of weaker wage growth ahead. So all signs, as you said, Enrique, suggest that the Fed probably behind the curve in cutting interest rates. A September cut is basically assured, fully priced in by markets. But what do we expect from the rest of the meeting? Enrique, what are your sort of general expectations ahead of next week's Fed meeting?
I think we're probably going to get at least a descent for 50 basis points, but I think you're also going to get a descent for staying the course and not cutting rates. I think it's going to be probably the least unanimous Fed decision in decades, is my expectation, because let's not forget that as much as the U.S. economy has weakened, inflation is significantly above target and shows no signs to be converging to that 2% target. And that means that the Fed has failed to achieve its inflation objective for 5 years running. It's at this point, if you cut in order to bail out the economy, which probably you should on balance, then some of the FOMC members are going to legitimately question whether the Federal Reserve is de facto giving up its inflation target and moving it to 3% instead of 2%. So it's a bad situation for the Fed. I think that the combination of its inability to bring inflation down to target and the unreliability of the data, which is, I guess, cannot be blamed directly on the Federal Reserve, has weakened the institution significantly and has made it vulnerable to this Trumpist assault on its independence. So while we may decry and condemn the assault, we should not forget that it didn't happen in a vacuum, and it happened in a context of prior institutional weakening.
A difficult balancing act for the Fed. As you said, we've got a situation where the labour market's clearly weakening, but inflation is still running above the target and expected to continue to climb as a result of the tariffs in the next few months. So yeah, good chance we do see a bit of dissent on the council. There are some of the market actually calling for a 50 basis point cut. I think there is a concern clearly that the Fed eases too aggressively with the possible impact of higher inflation due to the tariffs. Clearly, if the Fed goes too big too soon, markets will price in hotter US inflation, long-term yields would go up, the yield curve would steepen. What do you think, Enrique, about this possible calls for a 50 basis point cut? Do you think that's probably a little bit too much?
Yeah, particularly because, like I said, the U.S. the Federal Reserve is failing to meet both objectives. If anything, the failure to meet the inflation objective is more visible and obvious than the failure to meet the full employment objective. So a 50 basis point would cement the idea that the Federal Reserve has given up on its inflation target. And let's not forget that what matters here is not what happens to the short end of the curve, what happened to the actual Fed, but rather what happens to the long end of the Treasury curve, which is been selling off in the U.S. Rates have been going up, and long-term rates have been going up in the U.S. as they have in all of G10 countries. And the most important transmission channel from Federal Reserve policy to the economy is the mortgage rate. If long-term rates come down, then you get a wave of refinancing that lowers the interest rates for homeowners, puts money in the pocket of homeowners, and facilitates the purchase of new homes. A 50 basis point cut would probably have the opposite effect on the long end. It would signal to the long end that the Federal Reserve has abandoned its inflation target, and I think you're likely to see actually a sell-off, a rise in rates in the 10 to 30 year part of the curve. So it would defeat the purpose of the cut. So I hope they don't cut by 50 basis points. I don't think they will.
Yeah, wholeheartedly agree. I think that's the difficult balancing act, the line that the Fed has to tread. Clearly it needs to cut rates, but as you said, that 50 basis point cut, if we were to see one, would clearly spook markets. I think long-term yields would probably jump as a result. Markets would price in higher US inflation in the next few years. As you said, they would probably worry that the Fed is basically abandoning its inflation mandate and let inflation run hot, and that would be a big risk for markets. And I think that's something that they'll avoid. Let's shift our focus now to China. I'm going to bring Isabel into the conversation and tap into her knowledge and expertise in the region, particularly with regards to operating with Chinese businesses. Now, as we know, global trade has been upended in the past few months following the unveiling of Trump's tariffs in April, particularly trade with China. Clearly, China has been the biggest casualty of Trump's protectionism. Tariffs at one stage rose to as high as 145%, with China retaliating with tariffs of 125%, acting as an effective trade embargo. A temporary truce has been put in place that has lowered tariffs to 30% and 10% respectively, but clearly the future remains uncertain, and negotiations will continue ahead of the deadline, which has been kicked down the road to the 10th of November. Let's start, Isabel, right off the bat with how the tariffs themselves are impacting businesses in China. What have we seen so far, particularly with regards to Chinese exporters?
So thanks a lot, Matt. First, to continue with what you were saying about the tariffs. So right now, as you said, both US and China have set reciprocal tariffs. So the US tariffs on China are on an average of around 57% on 100% of all the goods imported from China. And reciprocally, for China, the average tariffs imposed on the US imports are around 32%. So both countries are at a bit of an impasse, and then definitely there has been an impact on the exports from China to the US. So what we're already seeing from the data released by the Chinese customs is that as of August 2025, the contribution of US to China's total exports have already dropped from 15% to 12%. And we're seeing a month-by-month decline. So July, it was already a decline of more than 20% on the US on the exports from China to the US. In August, this has been as much as over 30%. But on the other hand of things, right? Because already Trump, during his first term in 2018, was already imposing tariffs, and this has also allowed the Chinese exporters to start reshuffling and then adapting to the new normal. So they have a bit of time to prepare for that. Some anecdote that I would like to share, right? For instance, we have a client in China in the northern area of Qingdao. They are producers of fitness equipment, and then they used to export over 80% of those fitness equipment into the US. So for them, it's a huge impact. So what they have done, so they quickly reshuffle and they start looking at the domestic market, because as we all know, China has a huge population, one of the largest in the world. And what they did is that they started, based on the production capacity that they have, they designed transformable desks for schools. So that these are desks that during the lunch break, the child can just transform the desk into reclinable seats so that they can just rest. So this created a huge demand for them on domestic market, which was non-existing previously. So this is just an example of the flexibility and then adaptability that we see in the China supply chain.
Yeah, it's interesting. So clearly we're seeing this disruption in trade between the US and China. I was looking at the data yesterday. Exports to the US from China dropped 33% on the month in August, which is quite incredible. Imports were also down 16%. But actually, the data out of China is holding up relatively well, at least. I mean, the PMIs have been fairly resilient. Growth was, again, above 5% in the second quarter. Are we seeing this sort of shift away from the US? Is China increasingly diversifying, say, to the rest of Asia, particularly Southeast Asia? Is that sort of propping up the Chinese economy at the moment?
Yeah, you're exactly right. So we have seen how throughout the years the Chinese has been launching different initiatives with what we call the Global South, right? So we've seen the BRICS Alliance, the One Belt, One Road, and also the very important cooperation agreement, the RCEP, with the Southeast Asian countries, Japan, Korea, Australia, and New Zealand. So more and more we are seeing a very double-digit growth on China's trade, especially to these Southeast Asian countries that you are mentioning. So there is a combination of first, that the Southeast Asian markets, they are growing quite rapidly, and they also have quite a large population. So the Chinese are catering to that market, but also there has been, rather than a shifting of the supply chains from China to these countries, I would rather call it like an extension of China's supply chain with the Southeast Asian countries as well, right? So we're seeing how Chinese exporters, they are building factories there. There are already some sectors like textile, some of the electronics that are being moving into these countries. And then the most remarkable one is with Vietnam. So right now, Vietnam is already top 3 partner of China in terms of export, and it's experiencing double-digit growth. Also, in addition to Southeast Asia, so Latin America, Europe, they're also expanding into new markets, more on the Eastern Europe, especially Hungary. So yeah, indeed, there is being more and more interconnectivity between China and then the Southeast Asia and then traditionally emerging markets, which previously were not really the priority of the Chinese exporters.
And it's a really challenging environment for China at the moment, and not just talking about the tariffs. I mean, as we know, China's economy has been growing at an extraordinary pace in recent years, still in excess of 5%. But there are clear downside risks. I think we've talked about on this podcast quite a lot. And there is a possibility that China maybe could lose its status as a leading manufacturing hub in the world, particularly if we look at, say, Labour costs are going up. We've obviously got the tariffs, regulation is tightened. We've seen continued problems in China's property sector, and there are structural issues as well, particularly with regards to the country's ageing population, which are obviously going to be increasingly more of a problem in the coming years. So what would you say about China's sort of status as the world factory, if we like? Is that possibly at risk given these challenges?
So yes, I think in the long term, there's definitely going to be diversification from China that we're now seeing, but still at a very, very small scale. Because even if I look at the data from our clients paying into countries other than China, is still very small in comparison with what is being paid into China, right? Still like 70-80% of the payments are still going into China, although you're slowly seeing some to Southeast Asia. But then I would also say, right, that China has, I would summarize it in 3 points, right, that I want to highlight from China's traditional position as the world factory, which in the short, medium term, it probably will still keep that way. The first is that China has a complete industrial system in the way that there's a full supply chain there, so that, for instance, new energy vehicles, right? So in the Pearl River Delta, you can really find all the basic components that you need in order to build the new energy cars. So you have from the batteries, the electronic controls, so you don't really need to go anywhere else to import those materials. So that's really helping with a lot of efficiency. And this is something that you can find nowhere else. Then is the fast innovation, right? So China has also been trying to upgrade themselves. So there's this term that was crafted by McKinsey during the World Economic Forum called the Global Lighthouse Network, right? So these are the top factories in the world that are remarkable for their innovation in the what we call the fourth industrial revolution, right? So adapting to all these new technologies, big data, AI, robotics. So right now there's a bit less than 200 of these lighthouse factories in the world, and then China has over 40% of those. So this is really catering from all these factors that you were mentioning, increasing labor costs, aging population. So they're replacing it with higher innovation, higher efficiency, and also, last but not least, let's not forget that still China is increasingly dominant in some key areas. For instance, the new energy vehicles, which I mentioned a few times, solar panels, lithium batteries. So these are all categories that the Chinese government is putting a lot of investment, fostering the development and the investment of R&D into these sectors. We can see how, again, in the export categories, electric cars, if you look at it, 5 years ago, it was almost non-existing, China exporting abroad. And right now, it's already the top 3 category of China's exports globally. So I think what we're going to continue seeing is this trend of parts of the supply chain and then some sectors slowly moving into Southeast Asia, partly fostered by the Chinese investment, and also Chinese transferring a bit of the know-how and the labor skill, which I think is positive, so that China is also like upgrading themselves in terms of their supply chain and the innovation. So I would say in conclusion also that I feel that with the future of supply chains, right, and what's going to happen. So it's not only going to be who can provide the cheapest products, but also so who can be the most efficient, adaptable, and how the new technologies and what the role of innovation plays in all this.
Yeah, it's interesting. I think actually there is an argument to suggest that these tariffs maybe have long-term benefits for China because it could force the country to diversify into other markets and to innovate and to look at alternatives, which could be in China's best interest. So it's interesting.
Yeah, China has this central planning over 5 years ahead, right? So right now we're actually at the end of the 14th 5 years, And then we're looking forward to see how it's going to unveil the next 5-year plan, which is going to be from 2026 to 2030, right?
Interesting. Excellent. And I'm sure there'll be people out there listening to the episode saying, this is all very well and good, but how can we mitigate these challenges? So maybe this is a little bit of a shameless plug, but what can Ebury do to help businesses dealing with China in these challenging times?
So first, Ebury, as an international and global company, we have a footprint across the whole world. And then in China, we're present through our 3 offices in Hong Kong, in Shanghai, and in Shenzhen. And then we recently strengthened our suppliers liaison team based out of Shanghai and Shenzhen. And then the purpose is to also help smoothen the communications between our clients and their suppliers, not only in China, but also like in other countries that we were mentioning in Southeast Asia, right? So one thing that we are promoting a lot at Ebury within this de-dollarization that we're seeing globally is the importance, and I cannot emphasize it enough, the importance of considering to pay in your supplier's local currency, right? I'm not only talking about Chinese suppliers with the Chinese yuan, but that's very relevant also with the internationalization of the Chinese yuan, but also with the other countries in Southeast Asia, right? Because you are mitigating your risk, you're paying your suppliers in your own currency, and you have many more tools to limit the risk than what the suppliers have in the other side of the world. So from Ebury, we're very happy to assist there and also to brief for our clients on what's the latest that is happening in the markets and, of course, in China and the rest of Asia.
Fantastic. And as far as I don't think there's ever been more important time to utilize those tools, particularly given the tariffs and the uncertainty in markets at the moment. Fantastic. I think we'll wrap things up there. So thank you very much, Isabel, for joining us. We really enjoyed that, and hopefully all the listeners found that interesting and insightful. That was fantastic. So thank you everyone for listening and for watching, and we'll catch you on the next episode.